The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon, everyone, or good morning, depending on where you're joining us from today. My name is Brittany Melville. I'm the Director of Marketing and Sales here at Next Generation, and this month we've brought to you another educational series with a focus on using self-directed IRAs for pre-IPO investments. So with that, we have our guest today, Dan Mackel, who's the CEO of Silver Edge Financial. So we're going to be talking to you a little bit about the landscape of private equity and pre-IPO investments, and then we're going to tie that into using a retirement account to do these types of investments, along with some of the benefits and some guidelines for getting that sort of setup done with a self-directed IRA. So just a couple housekeeping things real quick. For anyone who couldn't attend live, or if you need to hop off early for any reason, we are recording the session. So you will receive an email following today's webinar with a recording you can access on demand at any time, and it'll also be available on our website on the webinars page, and you can view that through YouTube. Also, we've slotted an hour for this, so we're going to try to be respectful of that time since we know everyone's most likely at work right now. So we're going to try to keep enough time that we allow about 10 minutes or so for questions at the end. So if you have questions that come up throughout the presentation, you can enter those in the chat box that's on the right-hand side of your screen in that GoToWebinar panel there. So feel free to enter them in at any time, and we'll just use the latter side of the session to read through those and answer those for you. So with that, I'm going to let Dan get started and talk through the pre-IPO piece here. Welcome.
Thank you, Brittany. Thank you very much. Welcome, everybody. Thank you for your time. We appreciate it. Let me give you a little background on me. First off, I have 27 years in the finance industry. I've been a registered representative for FINRA for that time, and I am the CEO and the managing member of Silver Edge Financial, which is obviously what we're here to talk about today. Probably one of the most important things that, why we're able to do this business is the world has really changed over the last 20 years. The private markets are not what they were in 2020. Obviously, these big institutional investors, these VC firms, they make a lot of money investing at the earlier stages of these private companies. Now, the reason that I say the world has changed is 20 years ago, most of these big tech stocks, if you look at companies, like really all of them, you look at Microsoft, you look at Apple, Alphabet, Amazon, none of these companies ever reached $1 billion valuation in the private market. They went public first. Today, that's been turned on its end. You see companies like the Ubers of the world. These things get, tens of billion-dollar valuations before they ever go public, because they're able to raise so much. There's so much money out there in the private industry with the VCs. These companies are able to stay private much longer. As you can see in this slide, in 2000, the average time these companies stayed private was 4 years. Now it's actually over 11 years that these companies, they stay private. Why? Very simple. Because they can. So most of these entrepreneurs, these founders of these companies, they don't actually want to be necessarily a public company. Right now, the private markets are awash in private capital. So you get, these companies will take funds from, the VCs, the corporate venture capital, the hedge funds that have huge mandates to get involved in a lot of these private companies. You have sovereign wealth funds out there, mutual funds, family offices. There's so much liquidity out there, and obviously that's because of where interest rates have been over the last 20 years. These VCs can borrow money at next to nothing, lend this out to these private companies, and they grow massively in the private markets. So you can't, like the opportunity to own, something like a Google, for example. By the time these things come public today, a lot of those gains have already been taken off the table. And that's kind of where we come in. We look at it as, if you look, and hold on, let me show you this next slide here. the way the number of deals that have come out with the VCs has just on an annual basis has grown like hand over fist. There's more and more deals coming public. Why? It used to be the employees wanted these things to come public because for the simple fact that it was in their best interest. They wanted a liquidity event. You will have, and it's why it's been so beneficial to us. You'll have, employees out there in Silicon Valley that have been with the company, like for example, a Lyft. They've been there for 8 years. The stock is still private. They make a good living, but you make $120,000 out in Silicon Valley. You can't even buy a house out there. But these guys may be worth on paper $5 or $10 million. So they're cash poor, but they have a net worth there. So that whatever it is they want for a life event, they're having a baby, they want to buy a house, they want to get liquid in some of that stock. And that's really where we step in. It's been a huge benefit to us. Hold on a sec here. So because of companies like ours, we step in and we provide the liquidity to these employees. So some guy who maybe has $10 million in his company stock wants some sort of a liquidity event. Instead of an IPO, we can step in and, typically we don't buy all of that employee stock, but we'll buy $1 million, we'll buy $2 million worth of that employee stock, give them some liquidity, which gives them some breathing room to speak. And the companies love it for that reason because now their employees are happy. Now, one of the things that have enabled us to be successful is with the Jobs Act. The Jobs Act came out, and it used to be if you had 500 shareholders as a private company, you had to file as a publicly traded company. So the Jobs Act raised that to 2,000. But even that, no company is going to want to go over that 2,000 shareholder number for the simple fact that once you go over that number, you have to now file 10Ks, 10Qs as if you were a public company. So you have all the downside of being public and none of the upside. So obviously none of these companies are going to do that. So when we step in, we'll buy stock typically from an employee or an early stage VC. We add one shareholder one time, and then we can buy stock from 100 employees after that, and it never adds another shareholder. So there's a benefit to the employee, and there's a benefit to the company. So everybody, it really works out, and obviously there's a benefit to our investors either. Another reason a lot of these companies are staying private longer is these early investors. It used to be, hey, everybody wanted the IPO for the liquidity event. It's not like that anymore. They don't care. They'll hold these stocks. They know they can grow these things in the private market. And a lot of times it's even easier to grow it in the private market because there's no scrutiny. There's no press. There's no shareholders. They don't have to worry about any of that stuff. So they'll try to build it as much as they can in the private market. And that's why the guys like Zuckerberg, Dorsey, these guys, they'll keep them private as long as they possibly can and grow these things in the private market because they're not worried about that liquidity event, clearly. Another reason they want to stay private. Obviously, there's a lot of negative press. You see what happened or what's happening in the markets with Tesla and Elon Musk. Well, now obviously the stock's doing very well. But he's had a lot of issues just dealing with the press and a lot of the short sellers and the negative connotations that you'll see through the press and through the markets. These younger guys and a lot of them, they don't want to deal with this. So it's much better for them. And they've been able to do it because cash is now, it used to be in order to do acquisitions, to fund your business, you needed your stock as a currency. That's no longer the case today. Today, you can literally, they can go to these VCs and Uber raised tens of, billions and billions of dollars, Didi, billions of dollars, Airbnb, billions of dollars in the private market to grow these companies. So it's been a huge, huge benefit to these companies. High cost of being a public company, another downside to what why these entrepreneurs and these VCs want to stay private longer. Again, the short seller pressure that you have. So this is kind of where we step in. We have, I've been doing this for a long time. We have a lot of clients who are interested in getting involved in some of these pre-IPOs. You look at some of the IPOs, even they came out last year, that didn't do necessarily, great on the IPO. Companies like an Uber, companies like Lyft. These are companies that we were involved with that we did very, very well with, because if you're in prior, a year, 2 years prior to when these things go public, we started buying Lyft at $18 a share. So by the time this thing came public, they didn't do great initially on the IPO, but our clients were very happy because we were in early enough where we still had gains prior to that IPO. And part of the problem because these things are staying private longer, a lot of those initial gains are already off the table by the time they go public. So our strategy is we go out there. We have a network of attorneys in Silicon Valley, all across the country, really. We try to identify, what we believe are going to be the next kind of unique game changers, whether it's in tech, it could be biotech, it could be anything really out there. We have our analyst team look through these things, try to figure out which ones we think are going to be, the next big thing in the market. And we look to get and then make inroads in there and buy some of these shares from these private investors. How do you qualify? Fortunately or unfortunately, everyone that gets involved in the pre-IPO must be an accredited investor. We typically try to stay in a little. We don't go too early in the seed rounds because I think you need more of a shotgun approach at that thing. If you're getting involved very early on, it's very difficult to determine which of these companies have the staying power to really last and actually become a public company. So we've typically, it's kind of a sweet spot. We want to try to find something that's, there's still a lot of the meat on the bone there, but before they go public, but we're also confident that, there is an IPO sometime on the horizon. Can you liquidate before the IPO? Yes. If you get involved, we don't encourage it, but, we are typically able to move and find a buyer if you needed to get out for whatever reason, if you needed to get out of one of these shares prior to that IPO. This is slide here, just kind of a vision of the whole road to the IPO. If you'll see the first two stages, we kind of stay away because we feel like the third and the fourth stage there, as I just said, then we kind of understand, hey, these are companies that we feel do have the staying power and not only to be around, but also to take you to that IPO, which obviously is our, what is our goal. So these are some of the companies that we're working on now. A lot of them are companies you probably know: Airbnb, Palantir, SoFi, Pinterest. Well, Pinterest was one that we did pretty well with. That's obviously public now. We also have a pretty big position in Topgolf, if anyone's familiar with it. Some of these things are, we feel that really have an explosive upside over the next couple of years. And, when we think pretty limited downside, and we're pretty confident they will be in the next couple of years, they will be becoming an IPO. That's just a little background on me, just to give you kind of an idea of what I've done in my career. Brittany, that's kind of all I have, for you today. If anyone has any questions, or I don't know if you want to do your part of the presentation now as well.
Sure. Yeah, thank you, Dan. That was very informative. So I'm going to flip over to the discussion about using self-directed IRAs in the space. So I think Dan did a good job of explaining kind of the landscape from a pre-IPO perspective, as well as the strategy, the idea behind doing it this way. So if you already think that that's something that might be beneficial, imagine applying that to a tax-advantaged account, like an IRA or any other type of retirement account, basically. So we're going to talk about what that means as far as self-directed accounts, and then once we get through this, we'll answer any questions that are out there. All right. So just a quick overview as it relates to self-directed IRAs. A lot of people ask, what is your role when it comes to these accounts? So just to clarify, we're not a bank or a brokerage house. Unlike you might work with on a regular IRA, if you're invested in public securities, we are purely a custodian and administrator for these retirement plans, which means our job is to help set up the account, to hold the account for you, to do all the tax reporting and record keeping and administration related to the plan, which means that any distributions or investments that are made, deposits that are made into the accounts, we're processing all those, and we're reporting anything that we're required to report to the IRS for tax purposes as well. And then we're also doing a compliance review on any investments that are brought to us from our clients, who are the investors themselves, and determining whether or not these investments are compliant with IRS guidelines, which is very important if you're looking to gain the tax advantages that are one of the benefits of holding it in a self-directed IRA. So just a quick disclaimer for clarification. As I mentioned, we're not a bank or brokerage house. We're not fiduciaries or financial advisors. So we don't endorse or recommend or sell specific investments or products. We basically can hold anything that's compliant with the IRS guidelines. So it's more so a situation where an investor is coming to us and saying, hey, I'm looking at investing in ABC company. Here's the documentation for the company. Can I do this with my IRA? And we'll be able to tell you whether or not we can hold it, or if we see any issue with IRS compliance. But basically, the investor is the one to seek out those investment opportunities and products for themselves, and then to do some due diligence of their own as well to determine whether they're comfortable with that investment. So all the information that we provide is for educational purposes. We really want to set people up in a position to be successful using self-directed IRAs and make sure they're comfortable with the process, the expectations, so that they can, if they are going to employ the strategy, they can do it with confidence and hopefully have it be a long-term strategy for them. So just a quick background on the company. We're a women-owned business located in northern New Jersey, and we've been in business for about 15 years. We have $600 million in assets under management and a few thousand accounts that we hold and manage here for investors all over the country and even out of the country as well. So our CEO founded the company back in '04 and is still here running the shop. So she's actually got a background in real estate. And as you can see here, she's been heavily involved in a lot of financial organizations and recognized for awards in entrepreneurship as well. So the true definition of a self-directed IRA, because there are some terms that kind of are used loosely in this space, is really a retirement account that allows you to invest in what we call non-traditional assets or alternative assets. So obviously what Dan was talking about today, pre-IPO stock, that's private stock, something that is not publicly traded on the market, is considered an alternative asset. So this is our specialty in allowing you to hold non-traditional assets. So if you have a brokerage account with a Fidelity or the Schwabs of the world, and you're investing in your stocks, bonds, and mutual funds, that's great. You can continue to do that. But you also have other options to further diversify and take some of those funds and put them into alternatives. So that's really the biggest opportunity this is going to provide you outside of what you might already be doing. And then, of course, because you could be doing this with a retirement account, which is a tax advantage account, all the earnings on your investment are going to flow back into your retirement account, either tax deferred or tax free, depending on the type of account you have, which we'll talk about in a moment. But the other thing I would say from a benefit perspective, if you're looking at this to try to understand if it's a fit or what makes it actually different, is when you look at the market, and especially over the past couple days, we've seen a lot of volatility. It's a very sensitive market in general, and when things are good, they're good, and when things are bad, they're bad. So what some people are looking to do with this strategy is using it as one component of their overall financial plan to try to hedge against some of the stock market volatility that we've seen, because alternatives tend to be a little bit more stable over time, and they're not necessarily subject to that volatility. So that's one of the other things to think about, as well as the ability to maybe further control your return on investment, right? So if you're going out and choosing your own investments and you already have experience in these investment types, you might feel really comfortable choosing these investments and doing due diligence on them. And if you know about what kind of return you're going to expect, With certain types of alternative assets, you might get double-digit returns, whereas in the market, maybe you're lucky if you get 6% returns. So it's something to think about from that perspective as well. And these are really the main distinguishing features of a self-directed IRA versus what most people think of as just traditional retirement accounts. So why this is important is that the retirement landscape is changing, right? There is very limited left in Social Security. And for future generations that would like to eventually retire, there really will be little to nothing probably left for them. At the very least, we can say it will not be a sole source of income to rely on in retirement. We also don't see a lot of the traditional pension type plans that used to be available for employees. Typically you get a 401k, it'll give you so much, and then when you leave the company, you're not able to contribute or have any of those contributions matched, and you have to kind of take it and do something with it yourself, right? So we're seeing, obviously, you can see the statistic down here, over 20% of individuals over retirement age are still working. And that's partly due to the fact that they just don't have enough to retire. So what's happening is the onus is being pushed onto us as individuals versus the government or organizations to guarantee us anything. So it's just a suggestion that it's more important more than ever now for us to be taking control of our own retirement planning and the strategies that we employ. Here you can also see a trend toward increase in alternative assets in general in the industry. So about half of advisors saying they're going to increase their clients' allocation to alternatives, almost 3/4 of them to do so by up to 25%. And then when you look at the majority of the asset types being considered, these are all things that can be held in a self-directed IRA. So private equity, lending, and real estate are like the three most common asset classes that people hold in their IRAs. So you can see here that whether or not they're in retirement accounts, this is an area that's growing. So as far as the types of plans that you can establish and to be self-directed, all of these are self-directed plans we can hold. A traditional tax-deferred IRA, a Roth for after-tax dollars that then grow tax-free, and then for business owners, you have SEP IRAs, simples, and then other types of qualified plans like 401k plans. And then the last two are not quite retirement plans, but can also be self-directed. The education savings accounts for a child's education, which can be withdrawn tax-free for educational purposes. And then the HSA, which everyone's familiar with, can also be self-directed. And if funds are withdrawn for medical expenses, those are also tax-free. So ways to get funds into a self-directed account. There are several ways this can be done. You can make a personal contribution by depositing new funds into an account out of pocket. Just keep in mind that depending on the account type you have, the IRS does limit how much you can personally contribute on an annual basis. If you have a retirement account elsewhere, like an IRA with Fidelity, as we had said before, and it's all invested in the market, and maybe you'd like to take a portion of that and self-direct it into alternatives, your option would be to transfer some of those funds from your existing IRA to a self-directed IRA, which can be done easily by working with the custodian, and it is a non-reportable, non-taxable event. And then the other common method people use is to roll over from perhaps an old employer plan you might have. So as we said before, if you got that old 401k, you left the company, it's kind of sitting there, not really doing anything. If you wanted to roll over some or all of that, you could put it into a self-directed IRA as well. And then just lastly, if you had funds in a tax-deferred account, like a traditional IRA, and you wanted to put them into a Roth position for the tax-free earning benefits, you would be able to do what's called a conversion. It's just basically moving funds from a tax-deferred account to a Roth. So these are all, or most of the asset classes that can be held in a self-directed IRA. As we said, real estate, lending, and private equity are probably at the top of that list. What we're talking about today falls into that private placement, private stock category. So we'll focus a little bit more on that today. But just so you can see, there are so many options. You can pretty much get creative here as long as the asset is not publicly traded. And as you can see, the only two exceptions the IRS has put in place are life insurance and collectibles. So those two are not allowed in a self-directed IRA, but anything else that's not publicly traded is pretty much fair game for consideration. So the strategy that we're talking about here is basically, because there are so many different strategies you can use with a self-directed IRA, is to use your retirement account to invest in a private company or a fund, right? So in this case, with pre-IPO investment, your IRA is going to purchase shares or units of stock in a company. And another way that can be done is, by forming a limited partnership or forming a joint venture. But in this case, you're most likely going to be purchasing shares that make up a minority, minority ownership of the company. So it's just going to be more of a direct purchase of stock, right, or shares. So the IRA sends funds out of its account to purchase the shares, and then when the IRA liquidates its investment, it receives a return back in the form of dividends or some other type of equity, depending on the arrangement, right? So just to keep in mind, all returns on investment, if they're coming out from the IRA, everything that's earned on that IRA's investment goes directly back into the IRA, and it will remain tax protected as long as it's done in that way. So that's kind of the idea behind it, and that's the strategy that is used to accelerate retirement wealth in a self-directed IRA. So one of the most common questions that we do get in the case with pre-IPO investments, because typically it's inevitable that this company is going to go public in the near future, and I guess that's part of the strategy for getting in early, right, is what do I do when the shares go public or when the company goes public, right? So because here with self-directed IRAs, our specialization is in holding private assets and not directly holding publicly traded assets, because we're not a broker. Before anything happens, if you do have private stock in your self-directed IRA and the company goes public, you would want to contact your custodian for guidance on what to do next. So basically what's going to happen is, in order to be able to trade those shares or sell those shares on the market, they'll have to be transferred out of your self-directed IRA back to your brokerage account or regular IRA, for example. And what I mean by that is an account that you might have with a bank like Fidelity or Morgan Stanley, Merrill Lynch. So what you'd need to do would be to contact the point of contact at that account you have, and they would send us basically a transfer request to have those shares moved back over to them. So once that happens, we would need a letter from that custodian, that institution receiving the shares back, just to let us know we received the shares and confirming what they have. And then once we have receipt of that confirmation, basically what we do is we'll update the reporting on our end so that the shares are no longer in our custody. Because as long as they're in our custody, we're reporting that they're private and we don't have the ability to trade them. So what you want to do is have them transferred back to that brokerage account so then you can start trading, sell them. You can hold on to them if you want. But in order to have the flexibility to be able to make those decisions once they're public, you'll need to have them moved out of the self-directed IRA. And keep in mind, even if there's not a restriction period on those shares, you'll still need to follow this process before they can be sold. So you'll just want to, again, even if you don't remember any of this, before you do anything, contact your custodian to get guidance on the proper steps of the process. And it's really important that the reporting be accurate for tax purposes. So just something to keep in mind. And then something else to think about is if you wanted this to be a longer term strategy and you take those public shares and you transfer them back to your brokerage account, and now you're sitting here with your self-directed IRA, you can still utilize that self-directed IRA to make additional investments. So you can find a new company that you want to invest in. You can do real estate, you can do more private equity. So you have the flexibility to make multiple investments, even simultaneously within the same self-directed IRA, to continue accelerating that wealth. So if you wanted to do something like this with a self-directed IRA, you need to work with your custodian. Once you've set up your account and you've got funds in your self-directed IRA, your custodian will work with you to do a compliance review, as I had mentioned earlier, of the investment. And again, we're looking to see that everything is named appropriately on the document. So the investor would be your self-directed IRA's name, not your personal name, right? Because we need it to be a tax-advantaged account. for tax purposes. And then what we're also going to do is ask you to provide us some supporting documentation for that investment. So it's going to be any operating agreement associated with the fund, or if it's structured as an LLC, any certificate of formation for that entity. And then, as you would normally typically sign a PPM or subdocs for an investment like this, that same documentation would need to be reviewed and approved by you, and then we would sign it on behalf of your IRA. And again, we're just looking to see that everything is labeled appropriately, and that this investment is compliant with IRS guidelines. And then you also see here there's some internal documentation that we'll ask you for, and that's basically where you are self-directing us to make an investment for you. So you're telling us, I want to buy X shares of this stock at this price. I want the funds to be sent via wire to this account. How you want to pay for the transaction. So those are the types of things that we're basically going to ask you to send us so that we can execute the transaction for you. Now, prohibited transactions are something that the IRS has defined and that we look for when we do that compliance review. So although the only two things you can't hold are life insurance and collectibles, the IRS also looks at the individuals involved in your IRA's transaction, because there are certain individuals that are not allowed to directly do a transaction with your IRA. So as you can see by the definition here, they're defined as disqualified persons. So I'm going to skip ahead really quick and tell you what that means. So disqualified persons are going to be you yourself personally, any spouse, any children, basically your ascendants, descendants. So if you look at it, parents, grandparents, children, grandchildren, anyone that's providing you financial advice, like an advisor, any companies that are 50% or more owned by a combination of disqualified persons, and then any certain business partners, and then people providing service to the account, like a tax advisor or an attorney or a company like Next Generation. So you're not allowed to directly do transactions with these individuals, and the IRS defines it in a couple different ways. So they said you can't do a direct transaction with a disqualified person. You can't lend money or extend credit from your IRA to a disqualified person. And then if the IRA is investing in something, disqualified persons should not be benefiting from that investment directly, as it would present a conflict of interest. So these are the things we're looking for, and if we were to have a preliminary discussion about an investment you're interested in, we'd be asking questions to try to identify these things in advance. But a couple examples of what this means for private placements and pre-IPO in the pre-IPO space is that you basically can't invest your IRA into like a company that's owned 50% or more by a combination of disqualified people. So most of the time when people are doing this, that's not going to be the case, right? Because you don't really have a relation to any of the individuals that are owners of this company. So just keep that in mind, though, if that does happen to be the case. You also, if you're investing into a private company, you can't be an active partner, director, or a managing member. So the investment really does have to be arm's length and passive in nature. And then, of course, anything that you earn on that investment has to go back directly into your IRA, as we stated before. It can't directly go back to you personally. That would constitute a prohibited transaction, and that would create a taxable event. So if you wanted to take a withdrawal from your IRA, you'd first want to liquidate the investment, send the funds back to the IRA so that we have that documented, and then take a withdrawal from your IRA, which we would basically take care of and send the funds to you as a distribution. So the process for all this can take several weeks, and it's important that people understand this, because I think in the typical world of brokerage accounts and public securities, we kind of have this notion that, oh, well, I can just go online and hit a button and trade. Now, yes, you can with publicly traded assets, but with alternatives and private assets, there's a lot more involved in the process to review these types of investments and document them, because all of them can be so unique and different. So the first step in getting this type of strategy established is opening a self-directed account. So you would simply complete an application to do that. And once that's processed, it takes about 1 to 2 business days to get the account established. The second process is getting funds into the account, right? Because you need to have cash so that you can make that investment. So the second step is either going to, as we covered these options earlier, include a contribution or a transfer from an existing IRA or a rollover from an old 401 or employer plan, right? So you're basically going to let us know what option you're choosing, and then we're going to guide you through the process to make that happen. Now, I've seen this take as few as a couple of days or as long as several weeks, just because there's another institution involved that has specific requirements that must be met before they let go of your funds to send them here. And that variable we don't have full control over. So the more responsive you can be and the more you can work with us on that piece of the process, the quicker it can be done. And then the final step is obviously getting that investment made. So if you have a specific investment in mind when you open your account, you'll send us the documents that I went over earlier. Our compliance team will do that review, which takes anywhere from 2 to 5 business days for compliance purposes, and then we'll process that transaction for you. So, really this could take anywhere from, conservatively, from 4 to 6 weeks. I've seen it take less than that, but we do try to be conservative just because we suggest that people try to get into this more proactively in terms of setting up the account rather than waiting until you have an investment that has to be made next week, for example, and suddenly now you're scrambling to get the account open and the funds sent over. So just something to keep in mind if you think this might be something that you want to do. So with that, I know we covered a ton of information in a short period of time. If you do have any questions or you'd like to learn more, you're free to visit the website, nextgenerationtrust.com. My team does have its own group email address. For anything regarding a new account setup, you can email newaccounts@nextgenerationtrust.com, and then you can also call the office here in New Jersey. You will get a live person if you call. We do not have any voice prompts or recordings during business hours, and it should be easy to get in touch with someone immediately to answer your questions and help guide you through the process. And with that, I will open it up for questions, and I'll see if we have any. I don't see any right now, but I know we have several people that are on right now listening, so I'm gonna leave a minute or so for anyone to ask questions. Let's see. Someone did raise a hand, but I'm not sure if that indicates a question. If you did raise a hand, if you could type in your question, we'd appreciate it. So while we're waiting, Dan, hate to put you on the spot, but are there any common questions that you get in your space that might be helpful for us to address proactively since we have some time left?
Yeah, you know what? And I should have touched on this. Thank you. Probably the biggest question that we get from potential investors is, wow, this sounds too good to be true. So you can get me involved in some of these big name, Silicon Valley unicorns before they go public. And there's some skepticism there. And I didn't touch on it, but probably two of our greatest selling points are in that the people that we partner with. So we use a third-party administrator by the name of Tower Fund Services. Tower handles, if an investor sends money into us, Tower, it goes into an escrow account at Signature Bank that Tower handles. They do all the AML. They check to make sure all the contracts are in place. They actually send the funds to whoever we are purchasing the stock from. We also use Richie May as our auditor. Richie May, it's probably not one of the bigger known accounting firms, but they're actually very well known in the hedge fund space. We use them as our auditor just to make sure give people a level of comfortability that we're doing everything correctly and everything is copacetic, when they do business with us. So I think that's kind of one of the bigger issues there, just to make people feel a little bit more comfortable.
Okay, thanks, that helps. We did get a question while you were speaking. So the question is, apart from the stock market, IRA and Next Generation, is there another third party involved between the time we invest in the pre-IPO firm and the time it goes IPO? So, go ahead, Dan, were you going to say something?
Well, there's no other third party involved when and obviously, you know, we work hand in hand with Next Generation in order to deliver the stock. We can, once the company's public and any restrictions that it might have are lifted, we can actually send that stock to any brokerage firm that a customer is doing business with. We have listen, I'm Series 7 licensed. I have the ability to open an account for the customer here, an IRA account, and sell it for them if they want, but I can also deliver that stock literally anywhere. So where that you have a traditional IRA and we want to send the stock to, you just let us know where you want us to send it and we can send it over there.
Right. And, you know, I guess this question could be asking a number of things. So from another perspective, between the time you do your transaction and the time that the firm goes public, if you have any questions about your IRA or your investment, both companies are obviously available. So it's not like we process your investment and then we just disappear. As long as we're holding your account, we're responsible for providing any necessary reporting on the account. If you want to access your account online so that you can see any account activity or the latest value that's been provided, you can log in online. So when you set up your account initially, we give you all the instructions to set up online access. So that's another option. And then, of course, just any ongoing service needs are going to be available. You know, that's included in, you know, having access to the account as well. All right. Any other questions? I don't see any others, but we have a little bit of time, so we might hang out. And if anyone's been hesitating to ask, there is no bad question. Please feel free to ask anything. This is a topic that is unfamiliar and new to a lot of people. So there's really no bad question to ask if you're not sure of something. Okay, we have another one. I'm just trying to open this box up so I can read it. Okay. The other question is, what is the minimum investment for your firm? So, Dan, we can probably both answer that from our own. Okay, it's for Dan. I just got clarification. It's a question for Dan. Go ahead, Dan. Minimum investment.
Well, typically, like our PPM has a minimum investment of $100,000, but we break that out of discretion. We typically, especially for new clients, will bring it down to as low as $10,000. That's kind of our minimum dollar amount.
Okay. And with a self-directed IRA, there is no minimum because it's completely self-directed. So you can really decide how much you want to fund the account with. You can choose an initial funding amount for a specific investment you have in mind, and then you can obviously further fund your IRA in the future if you wanted to add more funds in from another IRA and transfer more money in, or you wanted to roll over additional funds into the plan. And again, you just want to weigh the investment amount against any fees that you'd be responsible for paying associated with doing this investment. So that's just, it's more so a judgment call for each individual to make, but there really is no minimum. All right. Let's see if we get any more questions in the next couple of minutes here. Excuse me. Okay, I think at this point, we have no further questions. So what we'll do is we'll wrap it up a little early for you guys. Thanks everyone for, excuse me, your time and attention. As a reminder, this has been recorded, so you'll have access to the recorded copy if you need to revisit it. And eventually you'll be able to get access to this webinar through our website as well. If there's anybody else you think that might be interested in watching this webinar that didn't register today, you can feel free to forward the recording along to them. And our contact information will be available in our email follow-up. If you'd like to contact either of us directly, we're happy to speak further one-on-one if you're more comfortable. Or if you simply just want more information sent to you so that you can review it, we're happy to do that as well. So with that, I want to thank everybody again for joining us today. We really hope that the session has been valuable for you and that you've learned something and it's given you a new perspective and a different way of looking at things. Feel free to subscribe to the newsletter on our website to be notified of future webinars as they're available on different topics. And we hope you all enjoy the rest of your day and take care. Hopefully we'll be in touch soon.
Thanks for your time, everyone.
Thanks, Dan, for joining us. We appreciate it.
Bye-bye.
Take care.